In September 2008, one investment bank collapsed. Within days, the global financial system froze. Millions lost jobs, savings disappeared, entire economies entered recession. That bank was Lehman Brothers, and this is how the 2008 financial crisis actually happened. Most people think the 2008 crisis was random, or that it was caused by poor people taking loans. That's not true. The crisis was created by banks, greed, and risk hidden inside the system. But here's what makes this story important for you. This wasn't ancient history. This happened less than 20 years ago, and the decisions that caused it, they're still being made today. To understand what went wrong, we have to start with how banks were making money before 2008. The housing boom. Let's go back to the early 2000s. The economy was good, interest rates were low, and housing prices were rising fast. Year after year, month after month, every home seemed to increase in value. Banks believed one thing: home prices will never fall. This belief became gospel. It was repeated everywhere, in boardrooms, on TV, in government reports. And based on this belief, banks started doing something dangerous. They gave loans to almost anyone, even people who couldn't afford them. Want to buy a $400,000 house? No income verification? No problem. No down payment? Fine. Bad credit history? We'll make it work. These were called subprime mortgages, risky loans, low-income borrowers, high chances of default. But banks didn't care. Why? Because they weren't planning to keep these loans. How banks hid the risk. Here's where it gets interesting. In the old days, if a bank gave you a mortgage, they kept that loan on their books. So if you stopped paying, the bank lost money. This meant banks were careful about who they lent to. But in the 2000s, banks discovered something clever, or at least they thought it was clever. They could bundle thousands of home loans together and sell them as safe investments to other people. These products were called mortgage-backed securities. Here's how it worked. Step 1. Bank gives out 1,000 home loans. Step 2. Bank bundles all these loans together into one financial product. Step 3. Bank sells this product to investors. Step 4. Bank gets cash immediately and gives the risk to someone else. Sounds smart, right? But here's the problem. Because banks could sell the loans immediately, they stopped caring whether people could actually pay them back. They just cared about giving out more loans. More loans equals more products to sell equals more profit. So loan standards got worse and worse. People with no jobs got loans. People with terrible credit got loans. People who were clearly going to default got loans. And all of this risk was packaged up and sold to investors around the world. Rating agencies labeled them as low risk. They gave them AAA ratings, the same rating as the safest government bonds. Investors trusted them. Pension funds bought them. Insurance companies bought them. Banks bought even more. Risk wasn't removed, it was hidden and spread throughout the entire financial system. And Lehman Brothers was deeply involved. Lehman Brothers' big bet. Lehman Brothers was one of the oldest investment banks in America. Founded in 1850, survived the Great Depression, survived world wars. But in the 2000s, they made a massive bet on the housing market. Lehman Brothers didn't just invest in these risky assets, they leveraged heavily. Let me explain what leverage means. Imagine you have $1. You borrow $30. Now you have $31 to invest. If your investment goes up 10%, you make $3.10. But you only put in $1 of your own money, so your return is 310%. Sounds amazing, right? But here's the flip side. If your investment drops 10%, you lose $3.10. But you only had $1 to begin with. You're now bankrupt. That's leverage. It amplifies both gains and losses. Lehman Brothers was leveraged about 30 to 1. For every $1 they actually owned, they borrowed $30. That means small gains looked huge, but small losses became deadly. They were making billions in profits. Their executives were getting massive bonuses. Everything looked perfect, until it wasn't. The cracks began to show. In 2006, something started to change. Housing prices stopped rising. Then they started falling. People who took out loans they couldn't afford, they started defaulting. Remember, many of these people had no income, no savings, adjustable rate mortgages that suddenly got more expensive. They couldn't pay. Foreclosures started rising. More homes hit the market. Prices fell further. More people defaulted. It became a vicious cycle. And suddenly, those safe mortgage-backed securities, they were almost worthless. Banks that owned these products started panicking because they didn't actually know what was in them. These securities were so complicated, so bundled and rebundled, that nobody really understood what they owned. It was like buying a mystery box and finding out it was full of garbage. Lehman Brothers collapsed. By September 2008, Lehman Brothers was in serious trouble. They owned billions in mortgage-backed securities, securities that were now worthless. They needed cash, fast. In September 2008, Lehman Brothers ran out of cash. They tried to find a buyer. Nobody wanted them. They asked other banks for loans. No bank wanted to lend to them. They asked the government to bail them out. The government refused. Why? They wanted to send a message. We won't bail out every company that makes bad bets. On September 15, 2008, Lehman Brothers filed for bankruptcy. $600 billion in assets, 25,000 employees, 158 years of history, gone. It was the largest bankruptcy in history. That single moment destroyed trust in the entire financial system. The panic spread. When Lehman collapsed, everyone started asking the same question. If Lehman can fail, who else is going to fail? Trust evaporated. Banks stopped lending to each other because they didn't know who was holding toxic assets. If banks don't lend to each other, the financial system freezes, and that's exactly what happened. Global impact. After Lehman collapsed, banks stopped lending, not just to each other, to everyone. Businesses couldn't get loans to operate, even profitable businesses, even businesses that had been around for decades. Without loans, businesses couldn't pay employees, so millions lost jobs. Without income, people stopped spending, so more businesses failed. Stock markets crashed worldwide. People's retirement accounts lost 40 to 50% of their value. Pensions were destroyed. College funds disappeared. The crisis spread from Wall Street to ordinary people everywhere. A factory worker in Ohio lost their job, not because their factory did anything wrong, but because the financial system collapsed. A retiree in Florida watched their life savings cut in half, not because they made bad choices, but because banks gambled with the economy. This wasn't just a banking failure, it was a system failure, and it affected billions of people who had nothing to do with Wall Street. The aftermath. Governments around the world had to step in. Massive bailouts, trillions in stimulus, interest rates dropped to zero. The economy eventually recovered, but it took years, and millions of people never fully recovered. Jobs lost, homes foreclosed, futures derailed. The real lesson. The biggest lesson of 2008 is simple. When risk is hidden and incentives reward greed, the system eventually breaks. Banks made huge profits by taking massive risks. When it worked, executives got bonuses. When it failed, taxpayers paid the bill. This is why understanding money, debt, and risk matters, even if you're not a banker. Because when the system breaks, it's ordinary people who suffer most. Why this matters today? You might be thinking, okay, but that was 2008. It's fixed now, right? Not exactly. Many of the same conditions exist today. High leverage, complex financial products, incentives that reward short-term profit over long-term stability. The names might be different, the products might be slightly different, but the game is similar. And that's why Gen Z needs to understand this. Conclusion. The 2008 crisis wasn't caused by one mistake. It was caused by many bad decisions stacked on top of each other. Risky loans, hidden risk, excessive leverage, lack of oversight, greed over caution. In the next videos, we'll talk about what changed after 2008 and why crashes still matter today. Subscribe to Gen Z Money to understand money beyond headlines. Because the next crisis won't look exactly like 2008, but it will follow the same patterns. And if you understand those patterns, you can protect yourself. Your financial future depends on it.